Chapter 8, Currency Markets. Section 5, Currency Impact on Investments. When you invest abroad, your return has two moving parts. One is how the asset performed in its own market, and the other is what happened to the exchange rate before that result gets translated back into your home currency. Even a solid local gain can look smaller or larger once currency is part of the story. Those two effects don't just sit side by side, they interact. A 10% local gain paired with a 5% currency loss leaves you with only about 4.55%, while the same asset gain plus a 5% currency gain lifts the result to about 5%. So currency can either cushion the ride or make it much more dramatic. Your home currency has a big influence on what you actually see in your account. If your home currency strengthens, the same foreign asset converts into less, and if your home currency weakens, that same asset converts into more. That's why two investors can look at the same foreign holding and report very different results depending on their base currency. Currency moves don't affect every asset in the same way. Bonds often feel them more sharply because the underlying yields are modest, so an exchange rate swing can easily overwhelm the income you expected to earn. Stocks, real estate, and other cash flow assets are exposed too, but the size and timing of that impact can be very different. It also helps to separate what's happened on paper from what's actually been locked in. While you still hold the foreign asset, currency moves can change your account value every day, but that result is still unrealized. It becomes realized when you sell, convert the proceeds, or receive income that gets translated into your home currency. The calculation itself is straightforward once you break it into steps. First, find the asset's local return, including any dividends or coupons. Then measure the currency change and combine them using the full formula rather than simple addition. That multiplication step matters because it captures how the asset return and the currency move compound together. Take a Canadian investor who buys a German stock. The shares rise 10% in euros, which sounds like a clear win. But if the euro falls 10% against the Canadian dollar over the same period, the investor still ends up with a small loss after conversion. It's a great reminder that local gains don't always survive the trip back home. One way investors deal with that uncertainty is by hedging the currency exposure. A hedge can make the home currency result track the asset's local performance more closely, often using tools like forwards, futures, or hedged ETFs. It can reduce surprises, but it isn't free, and it's meant to manage risk rather than magically improve returns. Currency risk rarely shows up by itself. It can combine with falling stock prices, bond losses, weaker translated income, or even tighter liquidity, and together those effects can make a bad outcome worse. That's why it's important to evaluate the asset and the currency exposure as one connected investment decision. A lot of avoidable mistakes come from focusing only on the asset and skipping the translation details. Investors may mistake a currency tailwind for manager skill, forget to include translated income and costs, or assume a short holding period means exchange rates won't matter much. The safer habit is to judge every foreign investment by its net return in your own currency after all the moving pieces are included.